So those are my decision makers.
Mhm.
I use those moving averages to say you're out, and I'm going to use them to get back in.
Mark, let's talk about designing stop losses, like what to consider there.
Well, I mean, it's part of your risk management plan. Okay.
Mm-hmm.
So for me personally, if I get into a position, I don't want to lose any more than 3%. Okay. On the downside. And I know in a volatile market, that can happen pretty quick.
Yeah.
But in a volatile market, it could drop 12%, really quick too.
Yeah.
Or so, I mean, that's how I look at it. It's just that simple. Okay. Paul, or you could use a trailing stop, where it follows your price up. So let's say you bought a stock at 10 and you put in a trailing stop, $2 under it at 8, and it goes to 12. Well, your stop goes up to 10 then. Okay. And as long as it goes up, you're still at that margin. And if it comes down and hits that, you're out. And I think one thing I've heard on this channel since I've been involved with it, with the members like Paul or Margaret or anyone, is the one thing they really learned is to put, that's really helped them, is to put a stop in.
Mm-hmm.
Paul, would you agree?
Absolutely. Absolutely. As soon as, for a swing trader, as soon as I buy the stock, I put a 3% in there, because the intent is this thing could drop at any minute and I'm going to be out. So,
especially in these markets.
And
So
especially these markets, and it's happened. It's happened. And I'll say they saved me, I don't know, pretty much every time. So if there's any stock that I've lost money, it's usually no more than 3%.
how about if you're looking at 12 months, your expectations is you built a position or you have a portfolio that's your core portfolio. You understand there's fluctuation, yet you can't have, say, 5 of your 10 positions go negative by a certain percentage, because it's going to take you off your course to where you want to go with that core money. What is a good way to figure the calculation of that, placing a stop? So if let's say you owned hypothetically Berkshire, and you expected to hold it for the next 10, 20 years, what would you look at to say, okay, if Berkshire goes down X percentage, I'm not going to hold on and ride this thing all the way down. I don't have 4 more years to recover from a loss in Berkshire.
That one's easy. Just look at the chart. You don't want to fall under the 50. So right now, 417.84.
Okay.
So I would put a stop in there.
Is that daily or is that a weekly, in your opinion?
For core positions.
Yeah.
For any core positions, I don't want to drop below the 50. You're in bad place.
That's on a daily chart.
Yeah. Oh, I'm looking at a 3-month daily chart. Yeah.
Okay. Okay. So you said, say, the 50. If it gets to the 50, I'm out, or a portion of my position's out.
Something like Berkshire. Well, yeah, for a core position, yeah, you want to use that moving average. Yeah, that's what I use.
If I were in a core, and I consider that long term, and I bought Berkshire B when it first came out. Okay, so I've been in it a long time.
Uh-huh.
If I were to consider, I think I would look at my cost basis and look at it opposite and say, how much have I made now? And where would I set that where I'm saying, I want to make this much,
Mm-hmm.
and it's sitting up here now. And if it comes and hits that point, that's when I would get out,
Okay.
let's say I'm up 200%. Maybe I put that at 100%.
And I think that's what we're seeing, especially in this tech sector, in particular, the Mag 7. Will there be great buying opportunities in the future? Absolutely. I'm re-listening to a chapter of the Unknown Market Wizards about the guy's name is Amaj Sasir, whose 13-year average return is 350 some odd percent a year, which is staggering. And he trades events and futures. He made the comment, he said, music is the space between the notes, meaning where you're going to make your money in markets is between the trades, between the investments. It's that sitting on the sideline and just looking for the right setup, the right conditions, and waiting. That's when you make money. It's not when you execute. And I think that's more and more I'm realizing that patience and process is so vital to making money. And I really, I'm with Kerry on this is a great opportunity. Right now, though, I'm sitting in between the notes. I'm just waiting for the best opportunity. And I think that's what we all have to think about.
And I think that's what the charts help us determine, as opposed to just throwing a dart at a board, and see where it lands. And right now I'm not seeing the turnaround yet where I would want to put money back into a swing trade or even an investment at this point, because there will be better times, but right now is not one of them, in my opinion.
Yeah.
And now is the time to really try to take emotion out of your investing or your trading and develop a trading or an investment plan and stick to it. I have an example of what my basic trading is on the Discord, in Platinum Discord. And when I stick to that and I trade between the lines, and you can go to the paper trade portfolio, that's what I do on that paper trade portfolio. I trade between lines, support and resistance. You get out, I put basically a 3% risk on the bottom side that I'm willing to lose on every trade, and let the top ones go up and probably hit either S1 or S2, or R1 or R2 resistance levels, and I get out. And if it goes higher, so be it. It goes higher. But I'm in it for all 9 innings. So I'm bunting, hitting singles, hitting doubles. I'm not trying for the fence. But over time, if you're making 2-3% a trade, and right now we have on the paper trade portfolio almost 200 trades through half the year, which you don't have to do that many, okay? And I certainly don't do all that many, but these are the setups that I find. And if you play them right, and you have a trading plan and you have a risk management plan, risk management meaning I'm going to set stops on everything that I have in the swing trade because I don't want it to go any further than X, where X is 7%. Paul, I think you use different percentages based on if it's a core position for you or a swing trade, right? You have different setups, like 10% on a core, and what do you do on swing trades?
I'll just be, on a core, I use maybe 5 to 10%, but I also use the moving averages, and I blew out of everything. I was smelling blood when it crossed the 20, and as we approached the 50, you got to get out. So, I'm going to say for my last X number of years investing, I've never been completely out of the market as I have been for the last few weeks. Yeah. So if we were Paul Tudor Jones,
yeah,
if we were, go ahead.
My trading philosophy over my life has changed in investing, and I'm probably similar with what Paul is doing, and Bob too. That look, I'm not going to get in a position where I'm down, 50% or anymore, because I've done that. I've waited, I've got a long trading career. I started investing in mutual funds when I was 20. Okay, so 40 some years ago, when we didn't have the internet, and I'd have to call in on the phone and touch tone my symbols and see what the price ended at, and I'd calculate it up every day. That's what a nerd I was. And then, you left them in your mutual funds, and then, the market would do what it does, and you're down, and you're like, oh my gosh, I had $1,000 in there. Now I only have 400, and you're like, wow.
Yeah.
And that's just the way you were trained to do it. And now with all the technology that's available to retail investors, like we can see what's going on, it gives us a fighting chance that I don't have to do that anymore. Like Paul's saying, I can look and say, what's my risk now, and manage my own risk, and get in and get out if I have to, even on long term, like an index fund. There's no reason I need to run an index fund based on what Paul Tudor Jones does, what he did in the Great Financial. He just got out when it crossed the 200. And if you go back and look at that chart, it was what saved him. I think, and I got to studying that. I'm like, well, why don't I do that? So that's kind of my thought process. going forward is I don't want to be down anymore. I don't want to wait. That's lost opportunity cost for the money I have. I could throw that money in a treasury bill and at least make, 5.5% maybe,
Yeah.
and as opposed to waiting for it to come back, and they always say you don't lose until you sell, which is true, but you're
You
also
don't-
not, that money's not working for you. It's
Yeah.
just sitting there.
It's sort of you don't lose until you sell.
Yeah.
You also don't get to use it either.
So
Well,
my whole philosophy just on investing and trading has flopped, and that's why I'm so cautious on the paper trade portfolio. And that's why I'm so cautious when I say, well, look at what's happening around you and don't get caught up in the hype, and like Paul says, he's looking at the charts now and he's not in the hype.
I try not to get caught up in the hype. I keep on thinking of you, Scott. I'm thinking, you may say Amazon just breached the 200, I'm out. And that could be like, so what's the emotional cost? Like for me, I can't sleep because I'm emotionally attached, and it doesn't make me feel good to know that I'm out, that I'm going to lose money. I sold all my positions. I lost nearly $10,000. Now, overall, do I feel good about that? No, I don't feel good about that. Did I do okay during the beginning half of the year? Absolutely, I did phenomenal. I'm up this year. It sucked though to sell the 10, but I could always go back and say, you know what? I sold it at the 50, or you could say I sold it at the 200, and I'll come back in later. I'll come back and get them later. So and then you're also released of the emotional stress that you have every day that you're in the market, knowing that you're down. That's a price too.
Yeah.
So it's different for everyone. I know some guys in here that feel okay being down 30% on margin, but wherever you are.
Yeah.
I don't think he's here, but that's you're relinquished of that stress too.
Yeah.
And there's no shame.
Cool. Thanks for y'all's input on that, because I think that is, no matter your time frame or how long you want to be in, or what that money's purpose for, if it's a short-term or long-term perspective, I believe you need to have that downside. Like how much, where is enough, where is too much? Where do I get out? And you can apply that and build that part of your investment plan. That's a business plan, so I appreciate y'all and your input on that stuff. So
anyone else, Jason or Eric or anyone, how you doing today? Are you guys
be alive.
enjoying what we're talking about, or it's just kind of been the 4-man show today? So the delinquency rate for commercial loans rose from 1.84% to 3.3%, highlighting the mounting stress on borrowers in this sector. In response to these economic challenges, major banks are adjusting their strategies. They're not only increasing their capital reserves, but also becoming more selective in their lending processes. And when we talked with Bob, who has his factories down in Florida, he also said about lending that they will, you can put in your paperwork on lending and they'll go through the whole system, but they're not lending money now. And that's what he was saying. And if he comes back, we'll have him talk a little bit about that. So according to Deloitte's 2024 Banking Industry Outlook, banks are tightening credit standards across all product categories, anticipating further tightening due to a less favorable economic outlook and a likely deterioration in collateral values and credit quality. And I think Trent, you said your friend in the business said they're getting audited by the Fed and they're downgrading a lot of their loans, their commercial loans.
So he is with about a $30 billion bank, and he is an underwriter for commercial real estate loans. And so he said they were in there the week that was last week, but he had lunch with another friend who is with a bigger regional bank, and they said basically one of the federal auditors said that basically every bank we go to, we're downgrading 30 to 40% of their commercial loans to substandard. And it's because the loans are just not functioning to their standards. So I haven't talked to him this week, but I suspect he'll probably experience a similar thing. So we'll see. But I think if you look at the 10-year US Treasury, which mortgage rates are based on that, right now it's at 3.81%. And that's that's a drop this week of 9.13% in just a week on the 10-year yield. I suspect I wouldn't be surprised if you're seeing the Fed becoming the market in 10-year treasuries, so these guys can refinance some of this commercial debt because of what they're finding at these banks, just to keep them liquid and solid. Because from my projections, I wouldn't be surprised if we see 3.4% within the next week, which creates a great opportunity if you have to refinance your house, if they do lower mortgage rates.
Yeah. And
Yeah.
there lies the trick is in
Yeah.
order to get a loan, you need a job and you need a good credit score.
Right.
And
Because
if you're,
yeah.
And if you're delinquent on your credit card and your car's getting repossessed, that's not going to happen very easily.
No.
No.
So I don't know. It's interesting, but he had been hired by Regions Bank during the Great Financial Crisis to reorganize and negotiate failed residential loans. And he made the comment. He goes, it's just funny how things cycle back, over time. It's just the same world but different sector, and that's commercial real estate.
Isn't the song say second verse same as the first?
Right, exactly.
Yeah.
So yeah.
I think even in homeowners, when we just talked about the ability to get a mortgage. One thing I didn't realize, and I just saw this, that thousands of homeowners who took an adjustable rate mortgage 5 years ago are set to see their rates suddenly skyrocket as they initially offer. They accept it expires and payments are adjusted based on the current market conditions. Okay, so 5 years ago, what were you getting? 3% maybe, or I don't know, on an ARM. But now, estimated 1.7 million homeowners have bought homes with adjustable rate mortgages since 2019, according to ICE.